This is a simple recap of what we discussed in class. Let's consider the decision of a bank officer in making a loan to a business. This type of decision will be based on several factors, such as previous financial relationship with the business and the financial condition of business, etc. As you can imagine, auditing itself has no effect on interest rate itself. I'm talking about market prevailing interest rate. Nor auditing has any effect on business risk itself. I'm talking about business risk of their client. However, auditing service can have a significant effect on information risk. In other words, if the bank officer is satisfied that there is minimal information risk because the borrower's financial statements are audited properly, the bank's risk is then substantially reduced and the overall interest rate can be reduced. So the reduction of information risk can have a significant effect on the borrower's ability to obtain capital at a reasonable cost. We also talked about that in the chapter that as our society becomes more complex, decision makers are more likely to receive unreliable information. There are several reasons for this. In a global economy, it is nearly impossible for the decision maker to have much first-hand knowledge about the organization with which they do business with. Right, remoteness of information. Second, if information is provided by somebody whose goals are inconsistent with those of the decision maker, then the information may be biased with certain motive in favor of the provider. We also talked about earlier the information asymmetry between the interest of the owner of the business and the manager of the same business. There might be some conflict there. Right. Third, as organizations become larger, so does the volume of their exchange transaction. And lastly, as you can reflect in the past few decades, exchange transactions between organizations have become increasingly complex and therefore more difficult to record properly. So how do we deal with this in our capital market? So the most common way for users, general public, like you and I, the prospective shareholders as an example, the most common way for users to obtain reliable information, I'm talking about financial information, is to have an independent audit service. Typically, management of private company or the audit committee for the public company engage the auditor, independent CPA, to provide assurances to users that financial statements are reliable. Right? External users, they are the ones who provide capital to the businesses who needs capital. Then those businesses, they hire independent auditor. Then independent auditor, they conduct audit service, assurance service, and they generate report that can be relied upon by users to reduce information risk we talked about. Right? So decision makers can then use the audited information on the assumption that It is reasonably complete, accurate, and unbiased. Right? Why do they value the auditor's assurance services, audit services? That's because the auditor's independence from the client and auditor's knowledge of financial statement reporting.